Hello everyone, this is Matt Stevenson, and today we're going to talk about prop trading pass rates. But more importantly, we're going to examine the why behind those pass rates and see if we can't solve some of the problems holding traders back from getting funded. As I've said many times before, one of Paragon's main goals is getting prop trading pass rates up substantially so that more traders can actually take advantage of the prop trading machine, right? Instead of getting chewed up by it. So that's what today's video is about. If you failed a prop firm challenge before, you're not alone. And it's probably not because you don't understand the market. Most traders fail because of how they handle risk under pressure, not because they can't read a chart. In this video, I'm going to walk you through exactly why challenges are harder than they look, the real numbers behind who actually gets funded, and the specific habits that separate traders who pass from traders who keep paying for new attempts. If you appreciate this type of content, go ahead and gently tap that like and subscribe button, and let's get into it. So first, let's talk about why challenges are actually hard. On paper, it looks simple, right? Hit a profit target, follow the rules, get funded. 3 steps, done. That simplicity is exactly what trips people up, because it makes the challenge feel like a math problem instead of what it actually is, a test of behavior under constraint. But the real obstacle isn't the profit target, it's the drawdown limit. And this is something we mentioned in another video. Most firms cap your daily loss and your overall loss. That means even a short losing streak can end your challenge instantly, even if your strategy is solid over the long run. A strategy can be profitable across 100 trades and still get disqualified on trade 12, simply because of how the losses were sequenced. In normal trading, you might give a position more room to work, a wider stop, a longer hold, room to be wrong before you're proven right. In a challenge, that same room can end everything in a single session. This is why traders who are genuinely skilled still fail. They're not playing the same game they think they're playing. They're managing a strategy built for open-ended trading inside a structure that punishes exactly that kind of patience. And here's what that looks like across the industry. Roughly 11% of traders who start an evaluation actually reach a funded account. Of those funded traders, fewer than a third ever go on to receive a payout. Sit with that for a second. Most of the people who ever even clear the first hurdle, still never see a dollar come out of the other side. That's not a knock on trading as a skill set, okay? It's a reflection of how unforgiving the structure is. But that's the cost of doing business. We need their capital, so we got to play ball. Most people don't fail because they picked a bad market or a bad strategy. They fail because they never adjusted how they manage risk once real constraints were introduced. Now, the next problem is emotional trading. And this is the one that ends more accounts than bad strategy ever does. Here's how it usually goes. A trader takes a loss, then another. Suddenly they're not following their plan anymore. They're trying to win it back. They have that reference dependence we've talked about. They size up. They take a trade that they wouldn't normally take. And that one impulsive trade is often the one that breaks the drawdown limit. It's not that they didn't know better. It's that the pressure of real money and a ticking clock makes discipline much harder to hold on to than people expect. Now we'll just take a quick break. If you want to actually put this into practice, Paragon Funded Trader runs evaluations built around real capital funding, not simulated accounts. You could check out account sizes and pricing at paragonfundedtrader.com. The link is also in the description and the pinned comment below. Now let's get back to it. All right, so how do you actually protect yourself from this? It starts with risk per trade. We always talk about this, but it's really, really important. I'd recommend keeping your risk somewhere between 0.25% and and 1% per trade max. I know that sounds conservative, and usually people say a little bit more than that, but better to stay conservative. Almost too small to matter, but that's the point. Here's why that works. If you're only risking a small amount per trade, a losing streak doesn't threaten your account. 4 or 5 losses in a row barely dents you. There was one point in my trading career that I had a losing streak of 14 trades. I was going out of my mind. Good thing I had a good coach to kind of help me through it. But if you're risking 3, 5, even 10% per trade, which a lot of traders do without even realizing it, especially after a string of wins builds false confidence, one bad stretch and you're done. Small risk isn't cautious for the sake of being cautious. It's what actually keeps you in the game long enough to let your edge play out over a large enough sample of trades. Next, and this one surprises people, trading less is usually the fix, not trading more. A lot of traders think they need to be active every day to make progress, like activity itself is proof of effort, right? And new traders for some reason think that because they're sitting at a trading desk, they need to be clicking to justify sitting there. Not true. Overtrading is one of the fastest ways to fail a challenge. Every extra trade you take that isn't a genuinely strong setup is just extra exposure to random outcomes. The traders who pass consistently usually take fewer trades, not more. 1 to 3 high quality setups a day, sometimes less. If you find yourself trading out of boredom, or because you feel like you should be doing something, that's usually a moment to close the platform, not open a new position. And finally, protect your drawdown like it's the only rule that matters, because functionally it is, and it's it's the one that knocks out the most people. You can be up nicely on profit and still fail a challenge because you got careless about how close you let yourself get to the drawdown line. Safe traders treat that number like a wall they never approach, not a target they can flirt with and back away from at the last second. Okay? This means setting your own personal stopping point for the day. Maybe you stop trading after a 2% loss or after 2 or 3 losses in a row, well before you're anywhere near the firm's actual limit. Build in a margin for error that has nothing to do with the firm's rules and everything to do with your own discipline. Give yourself a buffer. The traders who get funded and stay funded are the ones who treat their account like a business, with rules, not a single high-stakes bet. That mindset shift alone puts you ahead of most of the people who start a challenge and never finish it. So to recap, challenges are hard because of drawdown limits, not profit targets. Most failures come down to emotional trading, oversized risk, and overtrading, not a lack of market knowledge. Fix those 3 things and you'd be surprised how it changes things. And you put yourself in a completely different category than the traders who keep restarting the same challenge over and over. If you want help figuring out where your own trading is breaking down, or you have questions about evaluations, reach out to us by sending us a message to support@paragonpuntotrader.com or drop a comment with where you struggled most in the challenge, and I'll get back to you, as many of you as I can. Let's keep the flow of communication running. More information rather than less can only help us all, right? All right, guys. See you next time. Bye-bye.